Welcome back to the Noob Selling Options channel. Today, guys, we are unpacking a truly fascinating structural trade. We're looking at what might literally be the single most contrarian strategy operating in the financial markets right now. I mean, right in the middle of this historic, face-melting bull run for artificial intelligence, one of the most successful new hedge funds on Wall Street has quietly built an absolutely massive short position against the very companies leading the charge. No way, right? We're talking about an $8.5 billion options paradox. In this explainer, we're going to break down exactly who's behind it, why on earth they're doing it, and how they've structured the whole shebang. Okay, let's dive right into this. $8.5 billion. That is the nominal value of bearish put options stacked up against the biggest AI chip makers in the world. When the rest of the market is, screaming buy on every semiconductor and hardware giant out there, taking an $8.5 billion position in the exact opposite direction, that's the kind of move that either ends your career or makes you an absolute legend. It begs the immediate question, who actually has the capital, the conviction, and quite frankly, the nerve to place a bet this massive against the undeniable momentum of the AI hardware revolution? Part 1. Meet Leopold Aschenbrenner, the 24-year-old architect. To really grasp the weight of these market positions, you gotta look at this guy's remarkable timeline. Born in Germany, Leopold Aschenbrenner graduated as the valedictorian of Columbia University at just 19 years old. Crazy, right? By 2023, he was deep inside OpenAI, working on their elite superalignment team right alongside industry legends like Ilya Sutskever. His job was literally figuring out how to steer AI systems that are smarter than humans. But plot twist, in April 2024, he was abruptly fired. Now, OpenAI claimed it was for leaking, but Aschenbrenner countered that he was actually pushed out for sounding major security alarms to the board about state-sponsored espionage. Shortly after that whole dramatic exit, he launches his own fund, Situational Awareness LP, anchored by tech heavyweights like the Stripe founders. By treating artificial general intelligence, or AGI, not as some, distant sci-fi concept, but as an imminent macroeconomic reality, he completely disrupted the traditional hedge fund landscape. The guy ballooned his fund to over $20 billion in assets under management in less than 2 years. Part 2. The AI Power Bottleneck, Situational Awareness. That intense conviction regarding the future of machine intelligence, he laid it all out for the world right after leaving OpenAI in a massive 165-page thesis titled Situational Awareness, the Decade Ahead. This document essentially became the ultimate playbook for the current AI infrastructure boom we're seeing. His core belief is just fascinating. He argues that algorithmic progress, that's no longer the main hurdle. Listen to this core claim directly from his manifesto. The world is vastly underestimating the sheer physical scale of the data centers, power grids, and memory chips required. Aschenbrenner relies on deeply data-driven arguments, projecting that AGI will actually arrive by 2027 to 2030. But to get there, we need exponential orders of magnitude in compute. You can't just code your way to AGI, guys. You have to physically build the infrastructure for it. And that physical reality dictates literally every single dollar his fund deploys. Part 3. Miners as real estate, the stranded power play. Now, what's really interesting about this concept is if power and infrastructure are the true bottlenecks, where do you actually put your money? Building a standard AI data center from scratch takes years, mostly because of brutal permitting backlogs and grid connection delays. So to completely bypass this wait line, he's heavily acquiring Bitcoin miners. But, and this is absolutely crucial, there is zero evidence that Aschenbrenner or his fund are buying actual Bitcoin, okay? This is not a crypto play. This is a stranded power play. He targets these mining companies exclusively as distressed real estate. They already possess the land, the high-voltage substations, and those massive gigawatt-scale energy contracts. Retooling a Bitcoin mine for AI data hosting is up to 60% cheaper and vastly faster than building a whole new data center. It's a pure AI land grab. And we can actually see this strategy play out in his recent regulatory filings. As his fund's assets doubled to over $13.6 billion by early 2026, he optimized this miner portfolio. He wasn't just blindly holding general crypto exposure, he was getting surgical with it. In Q1 of 2026, he completely liquidated his positions in Cipher Mining and Hut 8. Instead, he aggressively rotated into Iris Energy and Applied Digital, and trimmed his massive position in Core Scientific. Why? Because he was identifying the specific companies that possess the absolute fastest, most cost-effective path toward retooling their substations for those highly coveted AI data centers. Let's look at the broader picture of his long positions from his Q1 2026 13F filing. His single largest public equity holding? It isn't a traditional tech software company. It's Bloom Energy, sitting at a massive $879 million. Blue makes solid oxide fuel cells, which basically allows data centers to generate their own off-grid power, completely bypassing the overloaded electrical grid. Super smart. Then you have SanDisk at over $724 million, a huge play on the premium flash memory needed to feed these gigantic clusters. And keep in mind, with SanDisk crossing $2,000 recently, that position has absolutely skyrocketed. He also holds $556 million in CoreWeave, an AI neocloud provider. So the theme here is loud and clear. He is fiercely long on the hard physical infrastructure required to keep AI online.
Part 4. The $8.5 billion short, the bearish overlay. Now here is where the story takes a really sharp turn into our central mystery. While he is incredibly long on the underlying physical infrastructure, SEC filings revealed a massive bearish overlay. We're talking a colossal short position constructed entirely using put options against the very first-order semiconductor giants that are currently the absolute darlings of Wall Street. Just listen to these striking nominal values. He holds $2.04 billion in puts against the VanEck Semiconductor ETF, $1.56 billion against NVIDIA, over $1 billion against both Oracle and Broadcom, and nearly $1 billion against AMD. Now, to be clear, he isn't bearish on AI compute itself. Remember, his entire life's work revolves around the imminent arrival of AGI. Rather, he's betting that the valuation multiples on these specific stock prices have vastly outrun the actual capital expenditure returns of the data centers that are buying these chips.
Part 5. The Structural Options Hedge. Why short the winners? For our retail options traders tuning in right now, you know that buying puts is a notoriously difficult, unforgiving game. So why is a brilliant 24-year-old taking on the undisputed winners of the market? Well, it comes down to options mechanics and structural market realities. Aschenbrenner believes that the equity multiples on primary chip designers have simply run way too far ahead of reality. He's choosing to capture AI's upside through second-order suppliers and power rather than these crowded, historically expensive trades. Let's break down the two scenarios. In the right case, his thesis plays out perfectly. Chip giants are capturing unsustainably high profit margins. As hyperscalers like Google and Amazon develop their own in-house chips and power bottlenecks literally stall new data centers from coming online, chip orders naturally slow down. Boom, his puts print massive returns. But look at the wrong case. Shorting NVIDIA means betting against an exponential monopolist that consistently crushes earnings. If next-generation architecture triggers another wave of upgrades, the stocks keep roaring. And because he is using options, he faces rapid time decay. If the market corrects after his contracts expire, he loses the entire premium paid. Boof, gone. So, the crucial point is he almost certainly doesn't need these puts to win on their own. Institutional macro trading isn't always about every single ticket being a direct profit center. When you manage $20 billion, survival and risk management are just as important as growth. This massive $8.5 billion short position is at its absolute core an insurance policy for a much larger, incredibly concentrated portfolio. And this brilliantly illustrates the overall architecture of his fund, the barbell strategy. On one side, he holds multi-billion-dollar long positions, not just the public infrastructure stocks we discussed, but also massive private equity stakes that are missing from the 13F filings, like his investment in Anthropic, which reportedly accounts for 20% of his entire fund. Huge! Then, on the other side of the barbell, you have the bearish chip puts. It is a classic Wall Street win-win. Think about it. If the AI boom continues, his underlying infrastructure and massive Anthropic stakes carry the fund to astronomical returns. But if the AI narrative bubbles and cracks, causing his long positions to take a heavy hit, his $8.5 billion in put options will absolutely explode in value, completely insulating his fund from the crash. Which leaves us with the ultimate question. Is Leopold Aschenbrenner a madman for betting $8.5 billion against the strongest momentum trade of our generation? Or is he a structural genius who has built a perfect, bulletproof portfolio for the dawn of AGI? Let us know what you think of this massive options hedge down in the comments. And hey, if you enjoyed diving into the mechanics of this trade, make sure to like this explainer, subscribe to the Noob Selling Options channel, and keep learning with us. Before you go, I want you to ask yourself this. If a 24-year-old prodigy is perfectly positioned for either an AI utopia or a massive hardware crash, which side of the barbell is your portfolio currently sitting on?